Being wealthy means different things to different people. How much do you feel you need to have invested for you to feel wealthy?
$100 billion.
We can really only count on two things while on this earth: death and the only thing worse, taxes.
Death and taxes?
Yes.
What an odd pairing.
No matter how wealthy you are, you're gonna die someday. But if you're rich, your tax bill might be relatively light compared to your income.
Not fair.
If you want to become wealthy, you obviously need to invest your money. One great platform for investing is Webull. In fact, I've got a link for it down below. If you open an account today and invest $100, they will gift you 2 stocks worth up to $1,850. So that's a no-brainer. Just click on that link below and start investing now. As a guy who's been an employee, self-employed, and a primary shareholder in a corporation, let me share with you some ideas on how you might pay only your fair share of taxes, but no more. Stick around to the end and I'll share with you some ideas on how you might be able to buy toys for your hobby and then potentially write them off by creating a business. I'm not a lawyer, CPA, or financial planner, so everything in this video is for entertainment purposes only. If you want actual advice, consult a licensed professional, or whatever else I'm supposed to say here. All income isn't created equally. Every income source has different rules, and if you understand those, it's going to be very beneficial to paying less taxes. Let's talk about the 4 sources of income that Robert Kiyosaki discusses in his book, Rich Dad, Poor Dad. By the way, if you haven't read that book, there's a link for it down below. Dude, you gotta read it. It's like finance, get rich 101 stuff. Most people are employees. They've got a job, they've got a salary or an hourly wage, and they pay taxes based on how much money they earn. Obviously, we're talking a lot about taxes in this video, and the tax information I share with you is current as of 2021, but will likely change during the current administration. The first tax is the federal income tax. If you make more money, you pay a higher percentage of your income in income tax. At the low end of the scale, people earning up to $9,950 per year pay 10% of their income in federal income tax. And if you make over about $523,000, you pay about 37% in income tax. They punish you for being successful, apparently. Next, we've got state income tax. Your state income tax is determined by your state of residence. If you're lucky enough to live somewhere like Nevada, Texas, or Florida, your state income tax is, ding, 0. If you happen to live somewhere like California, which has the highest state income tax, your rate is, 13.3%. That's on top of your federal income tax. Oh no, my lights went out. If you think I should charge my practical colored lights back there, give me a thumbs up and subscribe to the channel, man. Then I can get some battery backup with all the money I make from AdSense. You can see a clear correlation between state income tax and education. For example, California with the highest state income tax is number 1. Oh wait, no. 10, no. Oh look, California, number 20 for education. And then Florida with no state income tax ranks number 3 for education in the whole country. That's kind of interesting, isn't it? One way employees can defer taxes or pay less in taxes this year is by putting some of their income into a retirement account like an IRA or a 401k. If your employer offers matching, you should 100% do that to the max of the match. Note that I said defer taxes. It does not eliminate the tax. You have to pay the tax later, probably when you retire and in theory have less income, so we'll be in a lower tax bracket. The advantage is that you get to put more money in now, so it's going to grow tax deferred for the entire time it's in the retirement account, and you got to pay less taxes this year. If you're self-employed, yes, you can put money in retirement accounts just like employees, but you can also write off business expenses. That allows you to purchase some things for your business and not pay any income tax on the money that was used to make that purchase. The self-employed also have to pay a self-employment tax. That's 15.3% of their income. It is 12.4% for Social Security and 2.9% for Medicare. When you are an employee, your employer pays half of that 15.3%, but when you're self-employed, you are the employer, so you're gonna pay all of it. Depending on your income, taxes can take a huge chunk of your income when you are self-employed. Yes, you can write things off, but you are still going to be paying taxes. Now let's talk about the next level, being an actual business owner. The government provides some benefits and perks to some businesses because some of these businesses promote things that the government wants to encourage, like solar and low-income housing. Businesses also use debt to their advantage. They borrow money to buy assets. That borrowed money is tax-free. Then they use their income to pay down that debt, and the interest on that income can often be written off, thus lowering their taxes. Corporations have some other tax benefits. An S corporation is set up generally for smaller companies. In an S corporation, you pay yourself a reasonable salary and take out the rest of the income in the form of dividends or distributions. These distributions are taxed at a lower rate, thus you're paying less in taxes than regular income tax. You might be thinking, cool, let me just set up an S corporation and take all of my money out as a distribution. You can't do that. You have to pay yourself a reasonable salary. If you do try to do that and pay yourself a salary or wages that are too low and take out a whole bunch of money as a distribution, the IRS will reclassify all of your wages as regular income, tax you at the higher rate, and then hit you with penalties and fines. By the way, not only are taxes on dividends and distributions lower than the regular income tax rate, but you also don't have to pay that pesky 15.3% self-employment tax. So it is really a money saver. Bigger companies are often C corporations, but they face a little bit of a problem, which is called double taxation. A C corporation is a legal entity just like an S corporation, and a C corporation pays a tax of 21% on its profits. Oh hey, I just noticed I lost my last practical light. What do you think? Look better with or without all those colorful lights in the background? Go ahead and let me know in the comments below. Anything distributed to the shareholders is taxed at a max federal tax rate of 20%, thus double taxation. Once for the entity, the C Corp, and again as an individual. C corporations are not required to distribute earnings to the shareholder. They can choose to retain those earnings. They still have to pay the corporate tax of 21%, but they can defer paying taxes on the other earnings until such time as they decide to distribute those earnings or until the shareholder sells their stock. There's also a mean tax called the accumulated earning tax, forcing you to take that income out as wages and pay the double tax. If you're in this mess of trying to retain earnings as a C corporation, you gotta talk to a CPA because it's pretty complex. An S corporation is considered a pass-through entity because you take some of the money that the corporation earned, pass it through the entity, and you receive it as a distribution, paying less taxes on it. Because of the possibility of double taxation with a C corporation, as the years tick by, there are less and less C corporations and more S corporations. There are advantages to both kinds of corporations, so you really need to talk to a legal and accounting professional to determine which type of corporation might be best for your particular business needs. It costs money to set up and manage a corporation. Before we set up our corporation, we sat down with our CPA and determined what our income level needed to be before it was actually worth it to set up the corporation. And once we hit that level, we set up the corporation, and because of that, we've saved a lot of money in taxes. The last kind of income we're going to talk about is income you earn as an investor. And it doesn't matter which of the other three categories you fall under, as an employee, someone who is self-employed, or as a business owner, you can invest your money. What do the wealthy do with their money? They don't buy gadgets and junk and the latest iPhone. They take their income from their businesses and they invest it. Specifically, they buy assets. And anytime you sell one of your investments, one of your assets for more than you paid for it, that is called a capital gain. Long-term capital gains are gains you've made on assets that you've held for over a year. You'll generally pay a capital gains tax of 0%, 15%, or 20% on long-term capital gains, depending on your level of income. And this is usually lower than your regular income tax rate. Plus, another tax was added in the recent past. You may remember the allegedly Affordable Care Act. That added a 3.8% tax on top of the highest tax rate. So the highest tax rate on capital gains is 23.8%. Again, that's as of 2021. This could totally be changing during the current administration. If you've held an asset for under a year and sold it for a gain, you'll generally just pay ordinary income tax on that asset. So it's usually a better idea to hold your assets for over a year. Some assets like real estate have some huge advantages. When you buy real estate, for example, you generally leverage it. That means that you'll put maybe 20% down, on that property and then have the bank finance the rest. Let's use an example of buying an apartment building for, say, $1 million. You put down $200,000 and you finance the other $800,000. You've got 4 big wins when you buy a property like that. Number 1, you may be able to write off the interest on the payments. That means you don't have to pay taxes on the money you paid towards the interest, so you pay less in taxes, keep more in your pocket. Number 2, if you've leveraged the property and the asset appreciates, you're gonna make more money. In our example of the $1 million apartment building, you put $200,000 in. Let's say the apartment appreciates 10% or $100,000 in 1 year. That's a 50% return on your money, which is pretty amazing. Yes, there's other expenses, but that's just for an example. Number 3, with a real estate investment property, you must depreciate it over time. That means that even though the property may be going up in value, the IRS lets you assume or kind of pretend that it's going down in value, so you don't have to pay taxes on that amount that it depreciates, so you pay less taxes, you keep more money in your pocket. Number 4, you've probably heard of a 1031 exchange. That's where you take one investment property and after a certain period of time you can sell it even for a profit. Let's say you had that $1 million apartment building and you sold it for $1.2 million. That's a $200,000 profit. You can roll that money over into another like investment property and not pay any taxes at that time on that $200,000 that you made by selling that first property. So 1031 exchange, you can defer your taxes that way. That's a huge advantage. Here's the thing, you don't have to be rich to buy investment properties. You don't have to have $200,000 to buy a hotel like the one we used in our example. There are financial instruments that you can purchase through your wealth manager that will allow you to buy tiny pieces of investment properties and enjoy all the benefits of owning real estate with only a fraction of the money. So hit up your wealth manager and start investing your money, man. Once you wrap your head around all this, when you get your next check, maybe you'll start thinking, where can I invest this? Instead of, oh yeah, I can finally afford that new iPhone. Now let's talk about the potential to write off some toys. One thing businesses do is they have their businesses make business-related purchases so that they can write them off. For example, if you decide to purchase an RV and travel in it full-time and create a YouTube channel that you intend to monetize and generate income from, you may be able to write off a portion of that RV, of the repairs made to it, and of the truck used to tow it, and of all of the other expenses related to that travel that you are doing to create content for your YouTube channel, like I did with this channel right up there, Life Untethered. It's been kind of great. Now these are just ideas. I'm not a CPA. I talk to my CPA to see what I can and cannot do, what I can legally do to minimize my tax burden. The wealthy find creative ways to write off almost everything. They don't go on vacation, they go on business trips. They find ways to get to places, do business, and have a vacation there, and have the company pay for much or all of it and write off much or all of it. You gotta be creative, get a CPA and figure out what you can do to pay less in taxes and grow your wealth. The wealthy buy assets, they understand the basics of the tax code, and they all use CPAs. Which of those things are you doing? Remember to click that link down below to open your account with Webull. Again, if you deposit $100 today, you will be gifted up to $1,850 in free stocks, so it's a complete no-brainer. Click that link right there to see the habits that will make you rich. Hit that subscribe, which will guarantee that you'll make $1 million this year. I can't wait to see you become a gazillionaire.